Good afternoon, everyone. We are talking about chapter 21. In chapter 20, we learned how to make budgets for the upcoming year. Production budgets, sales budgets, materials budgets, etc. Well, now that we're on chapter 21, the year is over. It's the end of the year, and we're going to analyze our actual performance against those budgets for the purpose of making judgments. How did we do? Did we do as expected, or did we do better, or did we do worse? We're going to analyze our performance, and then we're going to work some homework problems from the chapter 21 practice. So some terminology. A budget report. It compares actual results to the budgeted results. This is what we expected for the year, but this is the actual is what actually happened. Here is a fixed budget performance report. What did we hope, or what did we expect to happen for this year? Well, that's here in the fixed budget column. We expected to sell 100. I think we're selling baseball bats here in this chapter. I think we expected to sell 100 baseball bats, but we actually sold 140. So because we sold 100 bat, we were expected to sell 100. We were expecting our sales to be 80,000. But what actually happened is our sales were 105,000. Now, this doesn't really address the question as to were our sales more because we sold more baseball bats, or because we were able to charge more for each baseball bat? If our actual results were 100 baseball bats, and that's what we planned on selling, but this was higher, nevertheless, then obviously we were able to sell each baseball bat at a higher price, which is good for us, right? So we could do some simple math here to see $80,000 split over 100 baseball bats. That's $800 per baseball bat. So if we take that $800 times 140, times 140 baseball bats, no, that would be 112,000, okay? We have a mixture here. Yes, this number is higher than that one, and that's to be expected. I mean, we sold 40 more baseball bats, right? But it is not 112,000 like we would expect, right? So apparently we were not able to get actually $800 per baseball bat. We must have sold them for less, because though this is higher, it isn't 112,000, which is what we'd expect. It's less. The difference between what we expected and what we actually did is going to be in the variance column, and there's an F there. F stands for favorable. It's of course favorable because this number is higher than we expected, so that's favorable. But why? Well, we did sell more baseball bats, so the quantity variance is good, but apparently we were not able to get $800 per bat, because that's 105 instead of 112. So the price variance is unfavorable, but overall, we still came out ahead. Now the variable costs went up, but that's to be expected, isn't it? I mean, we sold more bats, so we must have made more bats. So yeah, it's unfavorable, but don't get too sad about that. It's to be expected. I mean, we sold more, so each bat costs a certain amount, so it's expected this number is going to be higher. What's important is this number it's only 18,600 unfavorable, whereas the favorable amount of sales is more favorable than this is unfavorable. So overall, we're still favorable, aren't we? So unfavorable, it means, it costs more, right? See the cost, we want cost to be less, right? Well, here they're more, so it's unfavorable. But the unfavorableness is not as big as the favorableness. So overall, we're favorable. The fixed cost did go up a little bit, unfavorable. It's not too bad though. Overall, we still came out favorable, didn't we? Net income is favorably better. So this is a fixed budget, and that's fine. Fixed budgets are useful in some cases. However, we have here what's called a flexible budget. This is for, I guess, a different product. This is what we expected. 10,000 in sales, okay, per unit. And these are our costs per unit. And here under the flexible budget, we're going to put out some different scenarios. Like, how's it going to turn out if we sell 10,000 bats, 12,000 bats, 14,000 bats? But we just run the numbers, okay, and we see how we turn out. Again, this is the budget itself. This is not the performance report. This is all done at the beginning of the year before the year starts. This is a budget, not a performance report. Performance report comes at the end of the year. That's when we analyze how we did. So this is still a budget, but it's a flexible budget because it allows for 3 different possibilities. Now, the flexible budget performance report, this is done at the end of the year. These are our actual, we actually sold 12,000 units. So that's what actually happened. Therefore, we are going to pull the $12,000 column from the flexible budget and plop it in here. This is what we expected our sales to be, $120,000. Now, what actually happened? We actually did sell 12,000 units, but our sales were more than expected. That has to be solely for one reason. We were able to sell each unit at a higher price, which gives us more money. It's not because we sold more bats. I mean, 12,000, 12,000. We're comparing apples to apples, you might say. So this variance is a result of our price being higher than we expected, which is a good thing for us. Direct materials went up, which is to be expected. Well, is it? Because this is direct materials for 12,000 bats. This is direct materials for 12,000 bats. Yikes. So apparently the direct materials were more costly. You see, in this, the direct materials and these variable costs, they're higher, which I guess is to be expected because we sold more. But I mean, is it because we sold more and made more, or is it because the materials themselves cost more? Well, here we're comparing 12,000 to 12,000. So this direct materials being more costly is truly unfavorable because they must have been more costly per unit, right? Same with the direct labor, right? And all the others. So that's a flexible budget performance report. I think I have one of those in Connect. Yes, so let's do one of these. Let's do number 1 in the practice. Beach Company produced and sold 105,000 units in May. Look at this. Contribution margin on the 3rd line. You should already know that what minus what is contribution margin? Sales minus variable costs, right? And then, of course, if we subtract our fixed costs, we would get our net income. Yeah. So this formula is something you've learned several chapters ago. Now, according to the flexible budget, for the level of production in May, budgeted amounts were blah, blah, blah. And here's the actual amounts they gave us. So we actually sold 105,000 units. And these are the budget. So I think we'll just, for the flexible budget, we'll just put in 1,300,000 for sales. And the actual sales were 1,275. And the variance there is just the difference between those. So that's 25,000, right? Is that favorable or unfavorable? Well, we expected to have 1.3. We actually only had, that's unfavorable, right? Because sales were less. See, we're not dealing in positives and negatives here. We're dealing in favorables and unfavorables. Variable costs, we budgeted for those, the 750. And what actually happened was 712,500. The difference between 750,000 and 712 is 37,500. The first thing you do is get the difference between the two. So take the bigger one minus the smaller one. And then you have to ask yourself, is it favorable or unfavorable? We were planning on spending, cost of 750, but cost turned out to be less. That's good. That's favorable. So overall, the contribution margin difference, 550 versus 562. Ooh, this is better, yeah. So 562, 500, as opposed to 550. That's 12,500. And again, it's the difference between these two. You could also take the difference between these two. It's not that minus that or that minus that. It's just the difference between the two. Don't worry about signs and pluses and minuses. Just take the difference. So overall, while our sales unfavorable by 25, the variable costs were favorable by more. So if you look at these two, favorable wins out because it's more favorable than unfavorable. So this is going to be favorable. Another way to look at it is we expected our net income to be 550, or contribution margin rather, but it was higher, so that's good. Now the fixed costs, we budgeted 300,000 and it was actually 300,000. So no difference there. So no variance there. So again, the net income is also going to be favorable, right? 250 versus 262, because the net income is actually higher than we expected. So that's favorable. This is the budget for selling 105,000 units. And this is the actual results for selling 105 units. We're comparing apples to apples. The number of units sold is the same. So the differences are solely related to, well, the sales is us not being able to charge as much per unit, but the costs are favorable because the cost of materials and labor and whatever was actually less. And the fixed costs were the same. So I'm going to go on to the next one I want to do. That's number 4. All right, so hopefully you see a little correlation between this diagram here and number 4, and several of the homework problems are going to have this matrix for you to fill out. Correlation between that and this. So this little diagram that I have for you in the study guide correlates with this. So just give me a minute to explain how this works. The goal is to say, what's the variance? This problem is about materials. Compute the direct materials variance. In this column on the left, we have the actual quantity used. Ignore what's in parentheses. The actual quantity times the actual price. So actual amount of materials used times the price per pound or whatever, or unit or gallon, however much materials we're using. So this is a price per, let's say, gallon. And this is the number of gallons. This is the actual cost of materials for the year. And go all the way to the right. The S stands for standard, which means budgeted, what we expected. So this is the budgeted quantity of gallons we wanted to use, and this is what we expected to pay per gallon. So over here on the right is just basically what we expected the year to look like coming up. This is what actually happened during the year. And then in the middle, we have a mixture of the two, obviously, right? We have actual quantity used times what we thought we would pay per gallon. So I know that might be a bit confusing, but just go with it for now. I'm telling you, if you compare this column to that column, you're going to get the price variance, or the difference in what we paid per gallon, the price variance. Okay, if you'll notice up here, we are comparing actual quantity to actual quantity. So there's no variance or difference there. The variance is solely due to the price per gallon that we had to pay for it. So obviously, we are hoping the actual price is less than we budgeted. That'll make us look good. On the other hand, if you compare these two columns, this is the quantity variance. Look at this. Standard price or budgeted price per gallon, budgeted price. So these are the same between the two. So there'll be no difference there. But the difference lies in the quantity used. This is the standard quantity, how many gallons we expected to use. This is the gallons we actually ended up using. So we really want this to be less than that, because it means we're being efficient, where we're conserving. If we waste a lot of materials, especially, this actual quantity is going to be higher, and that's going to be unfavorable quantity variance. The combination of price and quantity variance is the total variance. So the total variance is made up of, can be due to a couple of things. The price per gallon went up, so we didn't make out as good, unfavorable if the price went up. Or if the price went down, we did better. That's just favorable, right? Or it could be we were more wasteful. We used more gallons in the process, possibly because we wasted them. Or there were do-overs. So let's take a look at this problem here. The company reports the following for one of its products. So we'll just fill in. Again, this is the actual cost. That's the standard cost. One little confusing thing, I'm showing AQ times AP up and down, but here's AQ times AP going sideways. And this is AQ times SP and SP, or SQ, SP. So this is AQ, if you look at your diagram, times SP. And this is SQ times SP. All right, let's look at some numbers and put them down in this matrix here. The direct materials budget or standard, we were hoping to pay $2 per pound. Hoping, right? Standard. So the standard price is $2. So SP is $2. So go ahead and fill that in where you see SP. Actual direct materials used, 300 pounds. That's my actual quantity, right? 300,000. We actually used 300,000 pounds of material. The actual price we paid, actual cost of direct materials used. This is total, right? The actual cost of what we actually paid for the direct materials. That's this. Oh, so they filled that in for you, didn't they? Okay. Anyway, go with the information they gave you. If they gave you the actual cost, that's actual quantity times actual price, right? So they gave us that and that. That is just, they backed into it. That times X equals 540. And again, I know the AQ is 300. I can put it in here too. Okay. Oh, but see, we actually used 300,000 pounds, but we were hoping to pay $2 a pound. So there's that, right? What do we actually end up paying per pound? We got a good deal, didn't we? This is the price variance, isn't it? Price variance. The price variance, see, quantity is the same. The price variance is, well, it's favorable, isn't it? Because we ended up paying less per pound. So it's 600,000, it's 60,000 favorable. I know, I can go ahead and do that. That's the price variance, direct materials price variance. Now over here, the standard quantity, I need to figure out how many pounds we meant to use. Here we go. Well, 4 pounds per unit though. How many units though? 60,000 units. There we go. So 4 times 60,000. That's 240,000 pounds. Okay. We had hoped to use that many. So we're going to use the 60,000 units because again, this is a flexible, budget thing. So we produced 60,000 units. We wanted to use 4 pounds per unit. That's 240. Okay, so here's what we had hoped to spend. Okay. So the price same, right? Now we were hoping to use 240, but we actually end up using 300,000 pounds. So that's not favorable. We used more materials than we thought we would. That tells me this is unfavorable because this is the same, right? What's different is the quantity. And we actually used more than we should have. We wasted. So I'm going to put unfavorable here. And this is the quantity variance. Now let's come up with the overall variance. That's the bottom. The total direct materials variance. Overall, are we more unfavorable than favorable? Yeah. See, the unfavorableness of it is a 120 and the favorable is 60. So overall, you know, we were 60. And overall unfavorable, right? Okay. So again, to get the overall variance, you just look at the price and the quantity, and you compare the two. The unfavorable is much bigger than the favorableness of it. So overall, we are unfavorable, and they kind of, the favorable and unfavorable kind of offset each other to the tune of $60,000. See, that's the difference between the two. So again, the whole chapter is basically this, just with different facts. Now I want to present to you another one. This is number 5, and this doesn't give you the matrix to fill out like this one did. Same diagram. I've just got it in Excel format so I can type onto it. All right, for the current period, K Company's manufacturing operations show a $4,000 unfavorable direct materials price variance. All right, so here's the price variance. So they're not giving you all this stuff up here. They're just telling you the bottom line. The price variance is 4,000. And it says unfavorable. The actual price per pound is $78. So the actual price per pound right here. I don't know if I need this, but I'm going to go ahead and type it in anyway. $78 per pound. The standard price is $77.50 a pound. Here. They gave us the prices, right? Standard and the actual. So right now I can tell you this is unfavorable, right? Because I mean, that's higher price than we hope to pay, right? 50 cents more, right? 77.50 versus 70. So 50 cents more. How many pounds of material were used? So how many pounds of material were actually used? So that is the actual quantity. They want to know these numbers here. Can we figure that out? Maybe use algebra. This is X, right? Time, and what's this difference here? 50 cents. So X times 50 cents equals 4,000. So what is X? 0.50X equals 4,000. 50 cents times X, yeah, that's the difference, equals 4,000. So if you divide both sides by 50 cents, you get X by itself. So $4,000 divided by 50 cents should be 8,000 pounds. So this number here is 8,000. Basically, we're solving for X, yeah? This times this minus this times this equals 4,000. The other one I wanted to go through, and again, I've basically finished the lesson. We're just working problems now. I want to do number 7 next, because this is about direct labor, and I wanted to point something out about direct labor. The terminology is a little different, but basically the same. On the left, we have the actual cost. On the right, we have the standard. And then in the middle, the combination of the two. On the left, we have AQ, AP, right? But instead of quantity, we're going to use hours. If you think about it, quantity is used for like gallons and pounds, you know, actual materials. When we're talking about labor, I mean, I guess you could refer to the quantity of hours, but we call them hours. So instead of AQAP, we've got AHAR. Instead of price, we call it rate, because we generally refer to employees' rate of pay, not their price. And on the right side, we would, of course, have the standard quantity is hours, and standard price is rate. In the middle, instead of AQSP, we would have AHSR, like that. So it's just the terminology is a little bit different when you're talking about direct labor. Let's try to fill in what we can. We are given the actual quantity of hours, the actual hours, 65,000. So they actually work 65,000 hours. The actual rate, this is what we actually did end up paying them, $15 an hour. What had we hoped to pay them? $14 an hour. Well, that's not favorable, is it? Standard rate. SH. SR, right? Standard hours, 67,000. And the standard rate is $14 an hour. Yeah, if you just look at the diagram I gave you, SS, AA, and AS in the middle. AS, SS, AA. Okay, I think we're good now. And you can check your work halfway through just to make sure you've got it good so far. Good. Again, the difference between this and this, AH, so that's the same. AR, SR. Oh, so this is the rate variance, right? Rate variance, direct labor rate variance, because that's what's different between the two. And here we have SR, so the rate's the same, but the hours are different. So this is the hours variance. What does that mean? Hours variance, direct labor efficiency variance, right? Because if they work less hours, that's efficient. So with materials and stuff, we would call this direct materials price variance, but with labor, we call it rate variance. And we would call this direct materials quantity variance, but with labor, we'll call it efficiency variance. At any rate, 975 versus 910, well, here we actually spent more than that. So that's bad. So I'm gonna put unfavorable for that. Okay, another way to look at it is $15 an hour is a heck of a lot worse than 14 an hour. We were hoping to pay him 14, we had to pay him $1 more an hour. That's another reason it's unfavorable. That's why this is higher than that. Not because of the hours, they're the same. It's the rate that's making the difference. And as far as the efficiency variance, that's, the hours versus hours, actual versus standard hours. We had planned on them working 67,000 hours, but they ended up working only 65. So that's less hours, right? So that's favorable for that. And again, here's what the standard is, what we had hoped for, but that's a lot less, right? So less paid for work is favorable. And the difference between these two, 65,000 versus 28,000, it's 37,000. So put that there. This is the overall labor variance, I guess, labor cost variance, total direct labor variance. And since the unfavorable is bigger than the favorable, we are overall still, unfortunately, unfavorable. And honestly, the rest of the homework is just more of that. Here's another one of these algebraic ones. We can go ahead and tackle this one because some of these can be tricky, but some of these are deceptively easy. Just know this diagram. A company shows a $20,000 unfavorable rate. Now, remember, the rate variance is like the price variance. So I'm just going to use this for that. It's 20,000. And it's unfavorable. And we have a $10,000 unfavorable efficiency variant. Again, efficiency is quantity, right? So it's 10,000 unfavorable So they gave us both of these numbers. The company's standard cost of direct labor is 400,000. So the standard, again, the standard cost, that's just the quantity or the hours times the rate. And that's the total. So 400,000 is this number here. Notice how they didn't give you this or this, but they just said the overall standard cost. That's standard number of hours times the standard rate. It's right there. So they're asking, what is the actual cost? That's this number. What is the actual cost of direct labor? They're asking for this number, which is actual number of hours times the rate, right? They're asking for this number. So here we have to do a little detective work, I guess. If the price variance is 20,000 unfavorable and the quantity, they're both unfavorable, right? So we are overall unfavorable, right, by 30,000. Okay, 20,000, 10,000 is 30,000. If one of these was favorable and the other was unfavorable, we would take the difference between the two. But because they're both unfavorable, we are super duper doubly unfavorable because they're both unfavorable. So 30,000. So now we need this number. We have this number. We know we wanted to spend 400,000, but we ended up being unfavorable 30,000, which means we spent more. So you must have actually spent 430,000. You really have to think about all these questions. It's not just going to be fill in the blanks and calculate the math. They're going to ask you all these questions in different ways. You have to really know and understand how this works. Sales variances, this is, I'm not going to go through this one. It's more of the same. Here we're back to AQ, SP, whatever. Fill in the numbers, calculate your variances. Remember though, we want sales to be higher. We want actual sales to be higher because they're sales. So if sales are higher actually than we budgeted, that's going to be favorable. There was one more I wanted to do. Management believes it has found a more efficient way to package its products and use less cardboard. This new approach will reduce shipping costs from $10 per shipment to $9.25. So it's going to save us 75 cents per shipment. And of course, you know that adds up. So this new approach is going to be really good. It's going to save us 75 cents per shipment. If the company budgets 1,200 shipments a year, what amount of total direct materials would appear in the flexible budget? Well, this is what we plan on spending, right? $9.25 per shipment, and we're going to ship 1,200 of them. So what's 925 times 1,200? This is our budgeted direct materials. That gives 11,100. So what's the cost savings? Well, this is 75 cents, right? So what's 75 cents times 1,200? $900. All right, y'all have a great rest of the week and let me know if you have any questions.